we're looking at the dollar-based fiat currency system post-Bretton Woods. That is now in a state of collapse. And we saw an acceleration of that collapse in 2024, which was reflected in a fall in the purchasing power of the dollar, measured in gold, measured in real money, not CPI or any of that stuff, by around about 25%. So that's what's going on. And it's never too late to buy gold, as you might put it.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today we have a fantastic discussion lined up. We're fortunate to have with us ALASDAIR MacLeod. ALASDAIR is an educator for sound money, economics, geopolitics, and everything to do with gold and silver. You could find many of his writings and his research on his Substack at alastairmacleod.substack.com. ALASDAIR, welcome to Metals and Miners, and thank you so much for joining us today.
Thank you for inviting me, Gary.
Yeah. So yesterday, it was reported that a surge in gold shipments to the United States has led to a shortage of bullion in London. What do you think's going on here? Why the rush to stockpile in the U.S.? What are the ramifications?
It's fascinating, isn't it? I mean, the story, if you like, as far as the media are concerned, is that, President Trump is threatening trade tariffs against all imports, including precious metals. I mean, it's a load of rubbish. That's not the case at all. The problem is, and you'll have seen this monitoring COMEX, the stands for delivery have just increased and increased and increased. I mean, it's just amazing the amount of gold and silver that being stood for delivery. And it's just draining, if you like, not so much the COMEX warehouse, because it doesn't necessarily leave the COMEX warehouse, but it's draining, if you like, the backing for the issuers, the sellers, if you like, of futures contracts. So, from a risk point of view, they're just getting more and more exposed, and they can see that there is a crisis developing in this. So what they're doing is they're trying to replace the stuff that's going out of the door, as it were, in the stands for delivery, with bullion from the spot market in London. Now, they've obviously cleaned out any liquidity in the LBMA vaults. So what are they doing? Well, most of these guys have leased gold from central bank's storage in the Bank of England. The Bank of England merely acts as an agent. It's got gold stored mainly for central banks. I mean, it's not exclusively for central banks, but it's almost all central banks, really, for every practical purpose. Others do have a little bit of gold storage there. I mean, it sort of happens when the Bank of International Settlements does dealing and stuff is sort of there before it gets delivered and so on. And also there's a bit of to and fro between the London Bullion Market Association vaults and the Bank of England. So it's not a completely clear-cut situation, but for all practical purposes, it's really only central bank gold that is stored in the Bank of England. Now, the Bank of England turns around to these central banks and say, well, you're complaining about the cost of storing your gold here. Well, there's one way you can deal with that, and that is lease it, and you'll get an income. Make it work for you. So you've got quite a number of banks. I mean, I know the Bank of Finland, for example. I had a bit of a tussle with them about 7 or 8 years ago about what they were doing. They were leasing out something like half their gold at the Bank of England. Now, we're not talking about a huge amount, but you can see that this leasing activity is actually enormous. Now, not only that, but unlike earlier leasing, when the carry trade was going, and under the carry trade, basically a bullion bank or a major outfit like Goldman Sachs, who wasn't a bank in those days, would lease gold, let's say from the New York Fed or somewhere like that, take delivery, sell it into the market, take the proceeds, and invest it in US Treasuries. And there's a wonderful trade because your lease rate was something like 1%. And in the late 80s, I mean, you were getting 10% on US paper, 6-month T-bills. Now, there was some research done by a guy called Frank Venerosa back in 2002, and he concluded that up to half all central bank declared reserves was out on lease. And because it had been delivered into the market, the way he put it, and it's probably adorning the next of Asian women. I mean, that was back in 2002, and we were talking about between 10 and 16,000. Now, this is actually all reported on Garter's website, so you can go and find the speech and all the rest of it. It's all there. The Bank of England does it slightly different nowadays anyway. I don't know what their practice was then, because what happens is that gold is leased and it's just a book entry, if you like. Ownership transfers from the central bank to the lessee. And the bank keeps it in the vaults and issues a bit of paper, in effect, to the lessee. It says, here you are, this is evidence that this is, you own this gold up until the end of the lease, whatever that is. So it's not normally delivered out of the bank's vaults. But now you've got a liquidity crisis on COMEX. Guess what? They're actually standing for delivery out of the Bank of England as well. In other words, there's a run on the Bank of England's vaults. I mean, this is just absolutely crazy. And so serious is this run that, according to an article in the Financial Times today, headline on front page, and remember, the Financial Times doesn't like reporting on gold. It hates gold. I mean, it's just like the Bank of England, as far as they're concerned, don't talk about gold. For them to actually headline this, I think is actually quite major. And what they have said is that it takes up to 4 to 8 weeks now to get your gold out of the, leased gold out of the Bank of England. Such is the queue. Now, some of it, that I think, is down to paperwork, because the Bank of England's got to be very, very careful that, everything is in order before they let it go out of their possession. But undoubtedly, this is an indication of the seriousness of the situation. Now, going back to this silly story about Trump introducing possibly tariffs, I mean, they're talking in silver about tariffs against Mexico. That was one thing I heard quoted. And they're talking about tariffs against Canada. And Canada, of course, is a major gold producer. So, ergo, oh dear, we're going to get a crisis. But I mean, this is just nonsense, because, when gold is refined, it loses its source of identity. It's just refined. And Trump has specifically said he's tariffing against, production, not against commodities. And indeed, he would be very, very ill-advised to try and put tariffs against imported commodities, because apart from anything else, I think the business community, the manufacturing community, I mean, imagine General Motors and Chrysler and all the rest of it, they'd be up in arms. They would make it absolutely certain, look, forget it, mate. You're not going to do this because you're just going to shut us all down. So, this story, I think, is just pure cover. It's so stupid. It's just pure cover.
Okay, so we've got this cover story, but what are the ramifications of what's really happening?
Well, the ramifications are that I think that the Western capital markets have ignored the scale at which physical gold, has been disappearing off into Asia for just too long. Whether there's been a deliberate suppression of the price or whatever, I mean, let's not get into that debate. But the fact of the matter is the price hasn't actually caught up with events. And I think that 2024 was the beginning of this deterioration. I mean, we've seen really over the last 2 or 3 years. I mean, remember that the COMEX market is not meant to be a delivery market. The only reason there is a delivery at contract expiry is to tie the contract to the physical price and be able to give you, let us say, a basis for, an arbitrage, which you would close not through delivery, but you would close by reversing your original positions. That was the whole object of COMEX. It wasn't really to deliver. I mean, it was just a technical thing. But the stands for delivery have been absolutely immense. I mean, they really have been. I mean, I've been tracking it for the last 2 or 3 years, and it's just amazing how it's escalated. And amazingly, again, as the price of gold and silver went higher and higher, this standing for delivery just went up and up and up and up. And even though we then had a fall in prices from end October, deliveries continued to rise and rise and rise. So the whole system has come under a horrible strain. Now, gold bugs, have been saying for an awful long time, that the whole futures market is a swindle and it's a means of suppressing, and eventually it's going to end in tears. The whole thing's going to fall apart. They're probably getting their wish now. That I think is what we're seeing. And bear in mind, Gary, that a little bit down the road, we may be talking days or weeks, a little bit down the road, we might begin to see counterparty risk really becoming a feature of this crisis.
So, okay, let's focus on a little piece here. Under Basel III, Alistair, gold's a tier 1 asset. Do the banks need more gold? Are they beginning to stack it kind of like, how the BRICS have been stacking gold for the last several years? Are the banks needing to acquire more?
Well, they do need it because, as you say, it is a tier 1 asset. But the qualifications for a tier 1 asset is that basically you've got to have it in your possession, or if not in your possession, in a fully certified vault, as earmarked as your property. So banks are reluctant to do this. I mean, you don't want to tie up your balance sheet with an unproductive asset. And of course, they've been playing this game too long. I might also say that, the leverage in the futures and the forward market, I mean, they didn't accept forwards as this sort of tier 1 asset thing for the very simple reason that it was a derivative. They looked at it, they said, this is a derivative. This is not the real thing. So you can see that the LBMA have been sort of kicking against this. But what has happened is that banks as a whole have increased their leverage through over-the-counter derivatives and also listed derivatives such as COMEX futures, so that their balance sheets have become more and more geared. Now, what has happened is that on their total balance sheets, they have also become more geared because the effect of reducing interest rates to zero, and in the case of Japan and the Eurozone, to negative interest rates, has been that banks have had to increase their leverage in order to protect the bottom line. And they're now so over-leveraged as to be, this is a real problem. Now, I think the nightmare in all this, Gary, is that if this crisis develops and spreads, it could actually infect the whole of the derivatives industry. And we're now talking about, hundreds of trillions. So, this is something that does actually need to be watched seriously, very, very carefully.
Very interesting. Okay, so as we're talking, gold's hitting new highs. The day before the election, Scott Bessent, the new U.S. Treasury Secretary, he stated, "We're in a long-term bull market in gold, and it's my biggest position." What does the statement by the new Treasury Secretary tell you about where you think things are likely headed?
Well, it tells me that he's pretty inexperienced for the role. I think the first thing that'll happen when he gets into the Treasury is his officials will take him by the collar and say, look, we don't want comments like that. And nor, incidentally, Mr. Bessent, do we want the president to say anything about cryptos. We do not want to promote Bitcoin as an alternative to the dollar. We do not want to undermine our own currency. Is that clear?
Some are wondering if he's doing that to get other countries to start purchasing Bitcoin in a sovereign fund rather than gold.
Well, this is a ramp. I mean, it really is. When you get the president, with Elon Musk and all these sort of techies from California, all singing off the same hymn sheet. I mean, they're just promoting cryptocurrencies. And I mean, they're making an absolute bloody fortune on the side. That's actually what it's about. It is completely amoral, immoral. I'm not quite sure which is the right word.
So,
This should not happen.
Let's go back to Treasury Secretary Scott Bessent's comments, though. You know, in all seriousness, his comments about gold and it being his biggest position, do you think that's transferable to some policy decisions that you see coming?
No, I don't. I don't see that at all. I mean, remember that Besant made his fortune and his name as a trader. He would have. I mean, I don't know. He probably just looked at the chart and thought, "You got to buy it."
Okay.
And he was unwise enough to state his position. So, but I wouldn't actually take any more meaning out of that than just him as a trader telling us how clever he is.
Okay. So, Alistair, let's talk about something else around gold. There's been plenty of discussion of a currency devaluation versus gold big enough to write off real value of a large portion of America's debt. I'm sure you've heard this discussion before. So with the debt to GDP in dangerous territory of approximately 125%, the concept has been kicked around as an answer. The Treasury currently rates gold at about $42.22 an ounce. So this is what has been theorized, that the new Treasury Secretary could instruct Fed Chair Powell to mark up U.S. official gold from that 42.22 to say 4,000 an ounce. Every $4,000 an ounce would equal about $1 trillion deposited free and clear into the U.S. Treasury. They could then buy back U.S. Treasuries and retire enough debt to get that GDP to debt ratio down to a much more manageable number of, say, 70% or so. And in that environment, the U.S. would then stand to greatly benefit from reduced taxes, reduced government spend, reduced regulations, reduced illegals, increased energy, et cetera. How realistic of a play by the government is that?
I think it's less realistic than seeing the cow jumping over the moon. I mean, this is the sort of rubbish you get. I mean, there's absolutely no way that any of this can work. I mean, apart from anything else, the valuation at 42.22 is actually in, I don't know, law, whatever. That is the supposed, gold exchange rate for the dollar. It is actually in the Treasury's hands, I think, as much as anything to set that. Now, I know it's the Fed's dollar, and you would think it's the Fed's decision, but I think it would actually be the U.S. Treasury's decision. The first thing that would happen is that we would all start screaming for, where's the gold? Prove you've got it. I think that's the first hurdle in that. The second hurdle is that, I don't know, somebody did once work out how many economic PhDs are all employed in the US Treasury and the
400
Fed.
or so, I think.
But I tell you, I mean, I don't think there's one of them actually that favors gold. So, I mean, the idea that these guys could actually sort of come up with a coherent monetary policy involving gold, I think we can dismiss. Furthermore, you've got to look at how the balance sheet works. If you're going to somehow do away with debt by selling gold, I mean, in theory that could be done if you've got the gold, as I just said. But the last time that the Fed tried to suppress the price of gold by leaking into the market, I mean, it had a series of sales, and I remember this back in the early 1970s. And I remember very well there was one sale of 375,000 ounces, which in those days was a hell of a lot. I mean, we get blasé about numbers like that. But anyway, it was a hell of a lot. And what happened was that Commerzbank went in and bought the lot for one client, an Arab. So, okay, right, we've got your gold. Thank you for selling it. What's your next trick? China would just clean them out tomorrow. I mean, no problem whatsoever.
Okay, so if you were speaking to an audience and talking to them about the importance of owning gold right now in 2025, what would you tell them?
Well, I tell them quite simply, it's not gold going up, it's the dollar going down. Now, that is a very, very important distinction between getting out of credit and getting into real legal money. Forget what the US Treasury propaganda has been saying for the last 50 years. Gold in common law is everyone's real legal money. Everything else is credit. So you're getting out of credit into real legal money. Now, if you look at the value of gold over long periods of time, it's basically pretty constant. Okay, it fluctuates a bit, and it'll fluctuate between, with individual commodities or whatever it is you're measuring it against. But you can go back to Diocletian's edict in the year 303 AD, and you can see that there are things in there which are the same price then as they are today, or the equivalent of what those things were. Prices haven't actually changed that much. One thing that's interesting, which will amuse your silver bulls, was that the gold-silver ratio was 12. At the moment, I think it's about 90.
Right.
But seriously, Gary, that is the point. It's not a question of, gold has got expensive or gold is in a bull market. No, it's the dollar going down. And, as my friend Steve Hankey says, the dollar is the least dirty shirt in the laundry. And I think it's a very good way of putting it, because the dollar goes down, but you'll see the trade weighted go up. Why? Because all the other currencies are worse. I mean, they're worse in the sense that they don't have the credibility that the dollar has and never will do. Maybe possible exception with the Swiss franc, but I think really that we're looking at the dollar-based fiat currency system post-Bretton Woods. That is now in a state of collapse. And we saw an acceleration of that collapse in 2024, which was reflected in a fall in the purchasing power of the dollar, measured in gold, measured in real money, not CPI or any of that stuff, by around about 25%. So that's what's going on. And it's never too late to buy gold, as you might put it. It's never too late to get out of credit, particularly when it is descending into a crisis. And that is the way to look at it. And I would add, Gary, that when people actually more broadly understand that, the currency's had it, it's toast.
Yeah, that's very well put, Alistair. Okay, so I'm sure you saw the press conference yesterday with Fed Chair Powell. After the press conference was over, President Trump responded on his Truth Social account. I'm going to read it. I want to get your impression of it, okay? So Trump said, because Jay Powell and the Fed failed to stop the problem they created with inflation, I will do it by unleashing American energy production, slashing regulation, rebalancing international trade, and reigniting American manufacturing. But I will do much more than stopping inflation. I will make our country financially and otherwise powerful again. The Fed has done a terrible job on bank regulation. Treasury is going to lead the effort to cut unnecessary regulation and will unleash lending for all American people and businesses. If the Fed had spent less time on DEI, gender ideology, green energy, and fake climate change, inflation would never have been a problem. Instead, we suffered from the worst inflation in the history of our country. What's your impression of President Trump's remarks, and where do you think inflation is headed?
I think President Trump's remarks are a bit self-serving, really. His diagnosis that the whole of the problem is due to the Fed focusing on, wokeness, diversity, climate change, is a load of rubbish. I mean, it really is. I mean, okay, there's been an element of that because they've had to do it under Biden, but that's not actually the problem at all. The Fed did make mistakes, particularly in its ability or its attempt to try and manage economic outcomes by using interest rates. That is always doomed to fail. And actually what the Fed has done, not just under Powell, but under his predecessors, is they've never allowed previous credit bubbles to actually work out, for the zombies, for the over-indebted, to meet their makers. I mean, that's really what it's all about. That's what the collapse of a credit bubble is all about. It's a sort of renewal, if you like. They haven't allowed that ever since really about 1985. And consequently, it's all rolled up into one huge, great credit bubble. And when I looked at the relationship between the yield on the 10-year US Treasury and the S&P, I mean, the S&P is now more than twice overvalued than it was at the time of the dot-com bubble. I mean, I thought that was the top of the bubble. I mean, we were all sort of thumbing into Charles Mackay's, seminal work on bubbles. South Sea bubble, Mississippi bubble, tulipomania, and all the rest of it, and thinking, I recognize this. This is all happening today. This is a huge, great bubble. Yeah, it was, but this is more than twice as big. Now, where people get this so wrong is that when you get a bubble like that, from the bank's point of view, there is too much risk in lending. It's as simple as that. So if you're going to borrow anything from the bank and the bank is going to agree to lend you anything, they're going to require a higher interest rate to compensate for that risk. So we're in a situation actually where interest rates and bond yields should be rising because of the increased risk that is attached to debt. Now, in the short term, what happens is that banks move their balance sheet away from the private sector, which is why the private sector is struggling. I mean, I can come on to why the statistics don't show this, but the private sector everywhere is struggling. I mean, not just in America, in Europe, in the UK, and all the rest of it, because the banks are withdrawing credit from there and re-lending it to what the regulators say are, safe. No, you don't need to make any sort of capital reserves for it and all the rest of it. Put it into short-term government debt. And of course, we've seen this in America big time. And we've also seen the lack of demand at the long end of the yield curve. Why? Because nobody wants to buy duration. So, what this is telling us quite simply is that the private sector is suffering. The US economy, despite what the GDP numbers say, is actually contracting rather nastily. Government spending is too high. You've got a budget deficit. And that's going to get worse because you're not going to get the tax income, which perhaps everybody has penciled in. And not only that, but in President Trump, I'm afraid you've got a spendthrift. This is so interest rates and bond yields are going to rise. It really is quite simple. There does come a point when, after the bubble has popped, when banks start going into lending into the private sector again, but it's a fairly slow process. They need to have confidence. And initially what happens is they'll find, they've got their pet industrialists who, are proven business managers. And these guys, company doctors will come in and sort out this, sort out that, consolidate this and consolidate. And they have actually relatively easy access to bank finance. And the economy gets going again. But, that hasn't been allowed to happen. It hasn't been allowed to happen since 1985. And the result is you've got this accumulation in a credit bubble, which is just going to go pop and take everything with it. I mean, if you want a symptom of this, just look at the cryptocurrency thing. It's not based on anything but hot air. It really is.
All right, I want to shift us over to mining here for a moment. Alasdair, there's been a lot of discussion by the Trump administration about reshoring manufacturing. Right now, the mining complex is just completely flatlined. If the U.S. really wants to truly reshore manufacturing, doesn't its mining complex need to be much bigger, much stronger, much more secure?
Yes, I think it does. It really hasn't had the access to capital which would allow it to have done that. And the reason for that is the portfolio shifts have been going into other directions, financial assets and also tech stocks and all the rest of it. I mean, you go to the major brokers, you won't find there's been any investment at all in researching mining stocks. So they've been caught out completely. I mean, it's just amazing how many exploration stocks, which are very, very good takeover prospects, are just languishing at pennies. Well, you'll know this from your business, but I've seen this before. I mean, it cycles, and I think that there is going to come a point where this disparity, which I just described between the return, the value, if you like, which is required in equities from the relative value from bonds, that is going to undermine equities. It's particularly going to undermine, the momentum stocks. People are going to start looking at value, and portfolio managers will then shift allocation away from that. They will make huge, great losses, but they will try and save what they can. They will shift away from that into, if you like, this new paradigm, which they see. They will understand, yes, okay, gold has hit new highs. We don't understand why. All right, there's been a crisis, which because MacLeod says so, whatever. But they will begin to buy into the mining complex, because it's not just gold. Right. I mean, basically, base materials have been increasing in value over last year. I think you're looking at something like 15 to 18%, something like that. I mean, it's less than gold. But on the other hand, that's really where the value is. The margins may be coming back in these properly run businesses and all the rest of it. And then, there's actually quite a depth there. The capital will come back. And I think that it's actually a very, very exciting prospect for well-run mines and, interesting exploration.
Yeah, and I agree with everything you just said there. So what brings the capital back? I mean, for instance, the gold miners just had their best quarter ever in terms of profits. Last quarter's record, $2,661 average gold price minus $1,350 projected all-in sustaining costs. It yielded $1,311 an ounce. It was an enormous 98.8% year-over-year growth from quarter four in 23. The major gold miners' earnings, they almost doubled last quarter, yet the GDX, it's languishing. So what brings this investment back? What's the trigger ultimately that says to the money managers, and everybody else, okay, we've got to be looking over there now?
Well, I think the trigger is the collapse of the tech bubble. I think we're very close to the top of that. We may have seen it, I don't know. But, I really think that's what's going to happen. You've got to have the portfolio managers running big money, beginning to reallocate funds away from tech stocks and into proper stuff like mines. I would also add, Gary, that, the sort of the general public view of gold and silver and commodities is, they are not at all bullish. They haven't bought any at all. Just look at the ETFs. When gold ETFs, there's been a little bit of net buying, but I bet those are big funds going into, the sort of, if you like, the really big ETFs. But, general public, no, they're still selling. And they're selling because, it's been an absolute dog or it's a source of funds or whatever. They were sort of originally in there for reasons which they've absolutely forgotten. It'll come back. And I think that, as we're speaking, we're challenging into new high ground. In fact, we are in new high ground as we speak for gold. And silver is really beginning to, perform pretty well as well. So I think, I can see that in this year and probably in the first quarter of this year, the public will begin to get a bit more interested. And of course, that sentiment also will be shared by members of the public that manage quite large money.
So it may not be high prices enough. Gold and maybe even silver can make record highs, but that's not enough to draw the attention of the big money into the equities. It's going to take them realizing that we no longer can get the gains to see the positive gains over here in tech, over here in the financialized assets. We've got to start looking elsewhere. What else looks attractive? Is that basically what you're saying?
Yeah, that's basically what I'm saying. They've got to get out of this sort of tech momentum investing and go back to value. And where is the value? Well, it's in the mining sector.
Yeah, it's unquestionable.
It's quite simple. You just laid it out, record earnings and all the rest of it. And here we are with the indices languishing at all-time lows.
All
Yeah.
right. Well, you brought up silver a couple times, Alistair. Silver's been in deficit going on 5 years. Silver's used in all the weapons and the electrification of everything. China's the world's manufacturer. The U.S. wants to reshore a lot of their manufacturing back to the U.S. The U.S. can't compete with China on low prices, but they could better compete if they get some of the base inputs like silver to become much more expensive, and China's not as low cost as they used to be. Silver has been absolutely dirt cheap, and it continues to remain that way, relatively speaking. In a sense, the U.S. and its allies, they've been subsidizing China with dirt cheap silver in their own efforts to electrify and, get off their reliance on oil. Why would they continue to do this? Do you expect silver to rise substantially?
Yes, I do. I'd correct one thing you said. It's been in deficit. This is the fifth year of deficit. Actually, it's the seventh year.
Okay.
Because there was if you look at the Silver Institute's numbers, I mean, there was a sort of deficit in 2019, I think, and then 2020, or it may have been sort of 18 and 19. There were net sales of ETFs, which put the thing back into balance. But actually, basically, in terms of mine output and scrap and all the rest of it, it's been in deficit for this is its seventh year. I mean, it's just absolutely remarkable. And you're right to point out they're still coming up with new technological uses for silver, silver, I think, has still got a lot of replacement value compared, replacing lithium, which is a very dangerous thing. So, I mean, that I think is going to continue. It's a funny situation because with the gold-silver ratio of 90, it's quite clear there's absolutely no money-ness, if you like, priced in silver at all. It is purely industrial. Yet, when gold goes up, silver tends to move up about twice as fast. The problem is that when gold languishes, it comes kettling back down again. It is very much, it's a thin, manipulated market, I think, is the story. But this is why what's going on at the moment is actually very, very important, with COMEX, because you're looking at premiums on the futures, which sometimes hit an annualized rate of 30% compared with the spot market. This is a crisis, and I can tell you one thing: the Bank of England doesn't store any silver, so there's no silver from that source. I mean, basically, I think the drawdown on silver stocks is something that has continued, and I just put myself in the shoes of a manufacturer or someone who has built up a little bit of stock. Am I going to push that out to the market in the hope that I can get the price down, or I think the price might come down and I can get it back cheaper? No, I'm going to hang on to the stuff. There's absolutely no way. So I think we're beginning to see something very, very important. And given its volatility and given it has been suppressed for so long, also given the supply deficit for so long, I think that when it starts running, it could run very, very quickly. I mean, I really do. And I would sort of think in terms of gold-silver ratio falling from the current 90 down, I think, through the 80s, maybe even through the 70s. I wouldn't like to push the relationship too far from there, but it would be really dependent on how gold goes. Now, as I say, it's not gold going up, it's the dollar going down. So the way to play the dollar going down, probably, if you want to speculate a little bit, is actually play it in silver rather than gold.
And I think your point about companies, sovereigns, organizations, et cetera, manufacturers becoming more protectionist over their stock is a very valid point, especially considering how long the deficit's been running and how needed silver is for all the applications. Okay, so this has been a wonderful conversation. Before we wrap up here and I ask Alistair our final question, I want to point everyone over to our Substack. Go to metalsandminers.substack.com. We post content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one with Alistair. They're all up there. When you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. If you don't own gold, you know neither history nor economics. it's a must read for everyone on why we all really need to own gold. So head over there. For our premium subscribers, we just launched the Inner Circle. It's a rotation of 2 to 3 monthly in-depth expert written analyses and insight reports into either the broader metals and miners market or a very specific metal or miner. They're written by the same experts that you see interviewed on the YouTube channel. The first 2 reports have already been published. They're a must read if you haven't already. They contain a lot of intelligence that you need to know. The next report's going to be published Wednesday, February 5th, and is written by none other than Simon Hunt. So head over to metalsandminers.substack.com and subscribe, receive the free gift. And while you're there, check out the Inner Circle and the premium subscription. Also, I'm positive that you've enjoyed the conversation today with Alasdair as much as I have. Please let him know. Hit that like and subscribe button and leave a comment below the video. Alasdair, are the U.S. and Chinese economies too big to stand apart or for one of them to fall, and therefore some kind of monetary restructuring deal that includes currency, trade, tariffs, interest rates, etc.? That kind of deal must be made and will almost surely be made within the first half of 2025. If so, what are some of the core components of a deal like that would you expect for all of us to see?
Well, Gary, I think you're being entirely logical, which unfortunately politicians are not. I mean, in an ideal world, we would like, all this sort of antagonism between America and China, which incidentally, I think under Trump is going to get worse. That should just go, and we should just learn to live with each other and maybe benefit from each other. I mean, Chinese technology has just taken off. I mean, I fell about laughing at this. What's it called?
Deep
the
Seek.
new AI.
Yeah, Deep Seek.
What? Deep Seek.
Deep Seek. Yeah.
I mean, they spend $5 million when Trump has sort of penciled in, you're going to have 500 billion to all his new tech friends. I mean,
unbelievable.
It's a joke. I mean, it just goes to show. And of course, the tech boys are all complaining, they're stealing our data and all the rest of it. Oh, to hell with that. I mean, Google's been stealing my data ever since I had. So, I think this is pot calling the kettle black here. I mean, the Chinese actually can teach us a hell of a lot, and I think it's damn stupid that we cut ourselves off from that. But
so
anyway,
you don't see a deal coming with them.
I don't see a deal coming. No, I think the relationship between America and China is actually going to deteriorate, and the reason for that is that the war in Ukraine is going to be lost. And I think what Trump will probably do is he will change policy to try and drive a wedge between Russia and China. So I don't think he's going to make many friends in China. Mind you, China's got the Sun Tzu approach to all this. They just let America make all the mistakes and just carry on regardless. So yeah, I think from their point of view, they're not flustered too much.
Yeah. Okay, Alasdair, thank you so much for coming on to Metals and Miners, for being so generous with your time, analysis, and ideas. It's been a lot of fun to spend the time with you. Would you please summarize your views that you've covered today and then let everybody know where they can learn more about your work and how they can connect with you?
Well, the message is very simple. We've got a big credit bubble, which is about to burst, and you just got to get the hell out of credit in order to save your wealth yourselves as well. And the way you get out of credit is to get into real money, which is gold, possibly silver, though that doesn't really rank as real money nowadays, but legally certainly gold. Do what the Asian central banks have been doing. And I suspect also that the customers of the Bank of England, the central bank customers of the Bank of England, will be kicking themselves that they were tempted into leasing out their gold. That is going to be, I tell you, that's going to be the story, I think, over the next month or two.
That's amazing.
As to what I do, I mean, basically, I find that interviews like this are so helpful to try and get the message out to a broader public as to what is actually going on. People don't understand money. They don't understand credit. You must learn the difference. I think that's desperately important. And underlying this, you've got a lot of other factors like understanding economics, which is vital. Macroeconomics is a non-science. It was invented by Keynes, and it should be confined to the dustbin of history. It will be in time, but after a crisis, maybe after the bubbles burst and people are searching for answers. And of course, there's a geopolitical situation where the world is splitting into two. You've got, the Western nations, traditionally have been the wealthy ones. You've got an emerging Asian cohort along with BRICS and all the rest of it. That's where the real opportunities are going to be. I mean, we're yesterday's story. That is the future. Learn all about this. I write about it in my Substack, which is ALASDAIRMACLEOD.substack.com. And if you Google MacLeod Finance, I'm sure they'll send you the link. So I very, very strongly recommend that you become a paid subscriber, and then you will get a proper education and information, which hopefully will save you a hell of a lot of problems in the future. And if you want to invest in mines and metals, then don't come to me. Go to Gary.
All right. Well, thank you very much for that plug. But I've been following ALASDAIR, guys, for multiple years. And I'm sure many of you who are tuning in now have followed ALASDAIR as well. You've listened to him. If you haven't, please, I'm going to put all the information up on the screen. Click through, go follow him, go check out some of his research, some of his writings. It's very important to get educated in the space. There's a lot coming down the pike here, headed our way, and we all need to be ready and prepared. So, ALASDAIR, I look forward to having you back on sometime soon. Thank you for being here with us, and everybody else, thank you for watching.
I look forward to it. Thank you for having me.
I want to point everyone over to our Substack. Go to metalsandminers.substack.com. We post content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one with ALASDAIR. They're all up there. When you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. If you don't own gold, you know neither history nor economics. It's a must read for everyone on why we all really need to own gold. So head over there. For our premium subscribers, we just launched the Inner Circle. It's a rotation of 2 to 3 monthly in-depth expert written analyses and insight reports into either the broader metals and miners market or a very specific metal or miner. They're written by the same experts that you see interviewed on the YouTube channel. The first 2 reports have already been published. They're a must read if you haven't already. They contain a lot of intelligence that you need to know. The next report's going to be published Wednesday, February 5th, and is written by none other than Simon Hunt. So head over to metalsandminers.substack.com and subscribe, receive the free gift, and while you're there, check out the Inner Circle and the premium subscription.